What is going on, investors? Hopefully you guys are doing well out there. On today's video, we're going to be talking about buying the dip and how this is an effective strategy and when your decision making on buying the dips can change. And so we'll talk about it in the context of several different stocks. We'll take a look at the S&P 500. We'll also take a look at some macro environments which could change our investing strategy going forward. Now, this is in response a little bit to some of the videos I've been posting here on my channel. A lot of people are saying, well, why aren't you piling into Facebook? This thing's gone from $300 per share all the way down to $200. Why aren't you buying the dip on this one? Why aren't you making video after video how you're just piling into this name? We'll talk about that. We'll also look at stocks like PayPal. Same thing. You could have bought the dip all along here and been underwater. Same thing with Alibaba. This thing's gone from over $320 a share to $118. Look at the ARK Innovation Fund. Kathy Wood was up over $120 per share just a few months ago. Now it's at 60 bucks. Now, some people might wonder, is my strategy effective? What kind of strategy do I employ? Do I buy the dips all the time? And the answer to that is absolutely not. I do not consistently buy the dips. In fact, I'm very strategic about my buying. Here's my IRA account. In fact, you can see the last 4 digits of it here. If you call up E-Trade, maybe you can hack my account. But my IRA account over the last 3 years, look, if it could go back further than this, I would, and I would show it to you. Unfortunately, I can't. I only get 3 years of data here, but my IRA account is up 94%. NASDAQ is up 81%. The S&P 500 is up 56%, and the Dow Jones is up 31%. This includes a big, gigantic March drop, and in fact, a recession, and obviously a big bull run. But more recently, I've avoided the big drops like Alibaba. I've avoided the big drops of PayPal. I got stopped out of Facebook, okay, so I could preserve my capital, preserve my gains that I have in my portfolio, and I certainly will get back into a stock like Facebook when the time comes. But I don't consistently buy the dips on this one. In fact, I haven't really bought a whole lot of stocks in this portfolio over the last year. It is certainly a buy and hold portfolio, but it's not a blindly buy the dip portfolio. I think a lot of people are confusing, especially when I read the comments on my video, buying the dip and buying and holding. Okay, absolutely, buying and holding is a fantastic strategy, but blindly buying the dip, in my opinion, will not always be an effective strategy, and I'll show you some examples here in a second. Now, if you want to calmly buy the dip and just constantly reinvest your money on the first of the month, quite frankly, I would lace up my golf shoes. I would turn off a channel like this. I would never tune into CNBC. I would never pay attention to the market at all. If that's what you want to do, I would go ahead and do that, and quite frankly, I would tune out all the noise. Now, for those of you that want exceptional returns like I've showed you here in my IRA account, look, there's not many people that are going to be able to show you that over the last 3 years they're up 94%, including the last more recent drop. Look, my portfolio has dropped, okay, but look, it hasn't fallen off a cliff like some of these stocks, including the ARK Innovation Fund. Well, there's a reason for that, is because in an uptrend you can calmly buy the dip, but I'll show you here in a second that the markets might not be in an uptrend. In fact, technically they're no longer in an uptrend, and so buying the dip at the current time is actually pretty risky. Could it work out? Absolutely, but I'll show you how risky it is. Here's just a meme that I brought up, and I just thought this was funny. Like, you know, they said to buy the dip, and here's a stock chart clearly in a downtrend. You could have bought the dip all along here and you'd be down. You certainly could pair this up with an Alibaba or a PayPal or Facebook and the same type of thing. Now, here's a real example of American Airlines. This is back just a couple of years ago. When this stock was in an uptrend, these blue lines, the stock's in an uptrend, buying the dip was actually an effective strategy. But now look at these red lines. The stock reversed here back in 2018. The stock reverses and now it's in a downtrend. You could have bought the dip all along here and you'd be stuck underwater, okay? And there's some reasons for that. Now, some of you might be wondering, how do we tell if a stock's in an uptrend? Well, it's not really that hard. Here's the SPX, okay? The S&P 500 index, essentially. And I made a green box here to just clearly illustrate after the March lows, the S&P 500 went on an epic run. And all along here, without fail, essentially, every time the stock market would dip, this is the S&P 500, every time it would dip, it would rebound and then come back to an area that was higher than the previous dip. So you could have bought this dip, had it go up, came back here, bought this dip, had it go up, bought all these dips all along the way. The reason why you could have done that is because this stock is locked in an uptrend. When stocks are locked in an uptrend, staying calm and buying the dip is actually a very effective strategy, and one I would actually recommend. When a stock and an index is in a firm uptrend, you can absolutely come in there and buy the dips. Now, what has changed over the last few weeks? People are wondering, why aren't you getting on here and saying you're all in on Facebook? You're cashing out your equity in your house and you're buying every Facebook share you can get. Well, first of all, guys, the S&P 500 is no longer in an uptrend. Take a look at this green bar. When this green box is broken here, now instead of making higher sets of lows, I told you we made higher sets of lows all along here. Here, technically back in October, it actually broke down for the first time. We actually made a series of higher lows essentially that were lower than the previous group. Now, it had a nice, some people would call this kind of a blow off top into December. And since then, we actually have made lower sets of highs and lower sets of lows all across the way. Now, we don't have a lot of data. We don't have any confirmation of this yet, but it is an area where me personally, as an investor, the age I am at, where I'm at in my investing career, this is an area where I take a pause. I don't snap go and buy Facebook. I don't snap and go buy PayPal. I don't snap and go buy Alibaba stock. I sure as heck don't go and snap buy the ARK Innovation Fund when the S&P 500 is all of a sudden making lower sets of highs. The stock market is down right here. Wouldn't surprise me, quite frankly, if the stock market rebounds at some point in the next week or two. But if we don't get above the previous sets of highs, which are right here at about 4,600 on the S&P 500, well, what we could do is start looking a lot like this meme where we dip, we come back, but then we dip lower. We dip back again, and then we dip at a lower price. Same thing could happen with this S&P 500. We could have a nice relief rally up in here to the 4,500 range, but then all of a sudden, the next week, 2 weeks, month later, we come all the way back down and create another lower sets of lows. Again, just like this meme, just like American Airlines stock, just like Facebook stock, although maybe not quite as steep, certainly like a PayPal, certainly like an Alibaba has been a pretty orderly downtrend, and certainly the ARK Innovation Fund has been a very orderly downtrend as well. The S&P 500 has changed. The uptrend is over, at least temporarily, and I think a prudent investor would actually wait for this to reverse. So what you might be asking yourself is, how is it going to reverse? It needs to create higher sets of highs. So we need to start seeing the reverse of our little meme up there. We need to start seeing the stock market do this, where we come up, we come down, and then we come up over our previous sets of highs. And then we come down a little bit, but then we go back up even higher than that up here. And some of you are saying, well, I want to get it at the bottom. I don't want to wait for a higher price. Well, this is proper risk management. There's nobody here on YouTube doing risk management videos, okay? Nobody would get any clicks or views on that. There's a reason why none of these guys are preaching that, okay? But this would be proper risk management, was actually wait for an uptrend and then buy it on these dips on the way up. People think buying the dip is actually what you do on the way down. No, buying the dip, because we've been in basically a 10-year bull run on the S&P 500 with a little bit of deviation, okay? There's obviously the March lows that we've had. We've had other areas where the stock market has completely broken down. But each of these times when the stock market has broken down, you could have been very patient. You didn't have to step in here and snap by this dip, okay? You could have bought it at the tops, honestly, and still been up huge, okay? So this is not a matter of timing the market. This is a matter of risk management. And one of the reasons, actually the primary reason why we're exercising proper risk management, is there's a number of different things that are going on in the stock market today that quite frankly haven't happened in a long time. Here's the consumer price index. This is a 12-month change. As most of you know, the consumer price index has risen by about 7.5% over the last year. Anytime it's gotten over 5% over the last 2 decades, it has triggered a recession. This gray bar right here between 2008 and 2009 was a recession. And you see that actually a recession is a cure for inflation. And so if the Fed can't successfully fight inflation, what is going to fight it all naturally is a recession. So we're on pace for a recession. And if we could overlay the S&P 500 chart on this, we could go all the way back to 2008, 2009, and I can show you that, yeah, the S&P 500 took a big, gigantic dump. Look at this. S&P 500 went from over 1,200, 1,300, all the way down to about 666, I think was kind of the key low for it, okay? So you shaved off 50% in just a couple of months on the S&P 500 the last time we had a recession. The last time we had a recession, the consumer price index was over 5. In fact, it was over 5.6. Right now, it's at 7.5. So if you don't imagine that a recession could be on the doorstep of the United States, you're absolutely insane. And here's another thing. This is actually probably an even better graph. So the red line is what I actually just showed you. It's essentially the consumer price index. The blue line is the federal funds rate. So there's two ways really to fight high inflation. And we see that inflation has actually gotten pretty high over the last, last year or so. It's represented in this red line. There's two ways that fight inflation. One is you have a recession, okay? It creates less demand, money circulates less, prices of goods and services go down when you have a recession. You look at home prices during this area that absolutely got decimated and got destroyed. Same with equity prices. Almost the price of everything except for maybe gold and silver got absolutely destroyed during these years. Now, the other way to fight inflation is you actually raise interest rates. That's represented by this blue line on this chart. And what I want to show you is that every time this blue line starts to go up and starts to peak, these gray shadows that are going up and down on these charts, this represents recessions. Notice every time the Federal Reserve has raised interest rates, in some cases to fight inflation, it's triggered a recession. So the cure for high inflation is either a recession on its own or actually the Federal Reserve raising interest rates, which also causes a recession. So unless inflation just naturally resolves itself and solves itself, the United States is headed for a recession, period, based on interest rates likely rising tremendously over the next year or two. And not only that, the high prices alone causing their own recessions. We could actually get a double whammy. The fact that the Federal Reserve is having to raise rates when inflation is high could trigger a gigantic recession. So not buying the dip on Facebook, not buying the dip on PayPal, not buying the dip on Alibaba, not buying the dip on ARK Innovation. Sure, could I miss out on a little bit of a move? Could the stocks rebound? Could inflation be overblown? Could our fears about it be overblown? Absolutely, it could be overblown. I'm still fully invested in my IRA account, but we're keeping a very, very close eye on that because unlike a lot of people giving advice here on the channel, I've lived through the late 90s recession. I've lived through the 2008, 2009 recession, and more recently we've seen it in 2020, but I don't necessarily think we've seen the full effects of what happened during 2020, shutting the economy down for a year, having these big, gigantic shifts in consumer habits and spending. So this video is not to make you concerned. This video is not to alarm you. It doesn't mean open up your portfolio on Tuesday and sell every position and just straight go to cash, but it's just showing you there are some indicators that not only has the stock market starting to top out, at least temporarily, but we also see a lot of stocks like Facebook, PayPal, Alibaba. We could bring up 100 charts that look exactly like this, where they peaked out late last year and have just been on free fall mode ever since then. And then on top of that, we've got the Federal Reserve raising interest rates into a high inflationary environment. Both of those things, both the high inflation and the raising of interest rates, both cause recessions historically almost perfectly in correlation. So we are concerned about that, and we'll be concerned about it until the market kind of proves itself otherwise. We'll certainly be here on the channel to let you know how it goes and let you know how this will evolve over the next year or two. I tell you what, in my over 20-year investing career, this has got to be one of the most interesting times. We are just off the highs of the stock market, and we've got the Federal Reserve having to make major moves in order to get inflation under control. And if they don't, that alone can cause a recession, a very large one, in fact. So stay calm. I wouldn't necessarily buy the dips. I would absolutely have a plan in this environment. Keep a close eye on the S&P 500. And if you're close to retirement or need this money anytime soon, you definitely want to practice some risk management over the next couple months and maybe even year ahead as we head into potentially some volatile times. Hopefully you guys enjoyed today's video. We'll be back again soon with more. Good luck with your investments.